and gold moved anyway. As the market digests that news, it wouldn't surprise me at all, given the near-term overcrowded nature of the short dollar trade, to see gold sideways to down. But if you have a 2-year time frame, a 5-year time frame, or a 10-year time frame, I think gold goes much higher. Investors who are more momentum oriented and traders definitely want to be in the gold space because now you're in the way of the money. And it's worthy to note that although the gold trade is attractive to you and I, given where we've been, most investors can't spell gold. It is not a crowded trade if the crowd that you're talking about is the generalist investor. The generalist investor, as is evidenced by money flows into gold-oriented and gold equities-oriented ETFs, is still very constrained. The gold equities ETFs are increasing in net asset value because the gold price is going up. In fact, they're experiencing a negative flow of funds.
Rick Rule's most recent observations provide a clear path through the chaos for investors attempting to understand today's erratic commodity markets. His message is straightforward but impactful. Gold and silver are still incredibly underowned, and this disparity has significant ramifications for future prices. Just a small portion of 1% of investment portfolios in the US are allocated to precious metals overall. Massive demand for physical bullion and the businesses that mine it might result from even a little return to historical standards. Rick's optimistic view is based on this asymmetry between a small base of ownership and the possibility of reallocation. He frames this opportunity in the context of a broader macro environment that few investors can afford to overlook. Persistent inflation, a declining value of the US dollar, and real interest rates that penalize rather than reward savers. In that context, gold and silver are logical stores of value rather than merely hedges. Be sure to like, subscribe, and hit the notification bell for more insights into gold, silver, and precious metals investing. Share your thoughts on the market in the comments below.
How are things developing in your eyes?
Well, two answers to that. Gold historically is extremely volatile. I think that the underlying trend in gold is up because I believe that the underlying trend in the purchasing power of the US dollar is down. But we've come very far, very fast. People who can't tolerate volatility need to consider taking some profits. I have no problem with volatility. I love volatility. I've been a beneficiary of it and a victim of it for 50 years, so it comes with the territory. If you ask me where we are in the gold bull market, really, I think we're very early on. I liken this to the decade of the 1970s. As we've discussed in earlier interviews, Danny, I believe it's likely that the US dollar loses ultimately 50 to 75% of its purchasing power in the next 10 years. Not relative to other currencies, but absolutely. The consequence of that is that I think gold trades higher. The shot that we've seen very recently, I think, is an advanced market indicator of the fact that investors and savers worldwide are very concerned about the impact of an interest rate reduction in the US. A widely telegraphed trade and gold moved anyway. As the market digests that news, it wouldn't surprise me at all, given the near-term overcrowded nature of the short dollar trade, to see gold sideways to down. But if you have a 2-year time frame, a 5-year time frame, or a 10-year time frame, I think gold goes much higher. I think the reason is that the primary buyer of physical gold is still foreign central banks. Not your audience, not my audience, not Ma's and Pa's, but foreign central banks. You'll notice that right after the move, right after the news, gold didn't rally because the retail buyer had bought ahead of time. The retail buyer had a look at the impending rate cut and said, this will be good for gold. And when gold happened, at least for 2 weeks or so, that buying had been used up. But the foreign central banks, people who have to allocate billions of dollars in savings, looked at this and said, this is another nail in the coffin of the US Treasury market. And that's too dramatic a phrase. But this weakens the competitiveness of the US Treasury market. And as we've seen, really, for at least 5 years, it has been disintermediation from US Treasuries into gold that has been responsible for the strength of gold. And that's continuing. Traditionally, gold bull markets follow a very predictable pattern. The metal moves first. And that was certainly the case this time. In prior interviews, I remember that some of your viewers were expressing frustration. 2022 as an example, the gold price was moving, but the gold stocks weren't. There was then a simple explanation. Foreign central banks were buying gold, and they don't buy gold stocks. So a market that had a bid went up, and a market that didn't went down. But there's a second reason that's much more traditional. It takes a while for an increase in the gold price to translate into an increase in gold producers' operating margins. We began to see that in 2024, and we saw it expressed on the market in 2025. In a typical gold bull market, it goes like this: gold to the best of the best, the Francos, the Wheatons, the Agnicos, to the best of the rest, the Newmonts, the Barricks, the Kinrosses, to the junior producer, the single asset producer, the developer, the explorer. What's changed this time is that the whole process of the money moving down market has accelerated. What happened in the prior bull markets in my lifetime is that the best of the best moved first, and they attracted market multiples, market capitalizations that were excessive relative to the rest of the sector. And so valuation arbitrage would take place. Guys like me, who said, Newmont is cheap compared to Agnico, would move down into Newmont or down into Kinross. Or if they didn't, the guys with lower cost of capital, which is to say higher share prices, would take over the smaller guys. What's been unique about this is that the whole process is accelerated. We have gone from the best of the best, the Francos, the Wheatons, the Agnicos, all the way down, even to the advanced explorers. And we've seen that happen in 18 months. That cycle through the rest of my career has taken 4 years, and it's interesting, and I don't really know why it's happened. Perhaps it happened because that sector was so ludicrously oversold. Perhaps it happened because life of cycle bottoms in 2021 and 2022 were farcically low, and what we've seen in the juniors is a dead cat bounce. I'm not sure what we've seen, but what I have seen is that the best of the juniors have all taken advantage of these higher prices to come to market to raise capital. And for the best of the juniors, all of these capital raises have been substantially oversubscribed, which tells me that the money is present in this bull market, and the gold bull market is really, truly underway. It also tells me that investors need to be more careful. If the price of a company doubles without any change in the fundamental news around the company, it is, of course, half as attractive as it was before the price doubled. And so people need to pay attention to that. They are no longer in the easy money part of the cycle. The easy money part of the cycle is when companies go from being hated to being tolerated. And gold is certainly no longer a hated asset class.
Rick addresses an important question in the following section of his talk. Who is the real buyer? Everything changes when institutional investors, big family offices, and sovereign funds start hoarding real metal. Delivery logistics begin to play a much larger role in price discovery, paper inventories decrease, and physical gold and silver premiums increase. As genuine demand tightens the market, the proportion of ETFs, allotted storage, and direct bullion ownership changes. Knowing where this demand is growing and which channels are tightening first can be crucial for investors. Early comprehension of these structural processes allows one to be ahead of the competition, while later understanding leaves others chasing pricing after the trend has already started. Make sure to like, subscribe, and click the bell icon to get notified whenever we upload new content. We really appreciate your support.
Has this not occurred before in previous gold bull rallies where energy prices have gone sideways to down while the gold and precious metals prices have gone up?
Yeah, that's not necessarily inconsistent philosophically. Oil prices often move as a consequence of broad economic trends. A soft economy on a global basis often stimulates quantitative easing, which is a fancy way of saying counterfeiting. The government response to a soft economy is often printing phony currency, which is good for gold. It doesn't always happen, but you bring up an interesting point in that it's likely that speculators and investors with a strong constitution need to begin to allocating substantially more resources in the oil space, which is hated or at least ignored. Investors who are more momentum oriented and traders definitely want to be in the gold space because now you're in the way of the money. And it's worthy to note that although the gold trade is attractive to you and I, given where we've been, most investors can't spell gold. It is not a crowded trade if the crowd that you're talking about is the generalist investor. The generalist investor, as is evidenced by money flows into gold-oriented and gold equities-oriented ETFs, is still very constrained. The gold equities ETFs are increasing in net asset value because the gold price is going up. In fact, they're experiencing a negative flow of funds. So this is a story that likely has legs, albeit it's a story that's going to be very volatile.
I can't remember who he was. It was some executive at Morgan Stanley that recommended a remix or a venture out of the typical 60-40 into a 60-20-20, 60% stocks, 20% bonds, and 20% gold. I mean, gold has been severely underallocated for the past few decades. What does it mean when serious investors like that begin allocating 20% of their portfolios into gold?
Well, to put that in perspective, Danny, the last statistic I have was from J.P. Morgan Chase. And J.P. Morgan Chase said that the overall, the global allocation to precious metals and precious metals equities in the U.S. was only 0.5%. Put specifically, 0.5% of the total savings and investment assets in the United States are allocated to precious metals and precious metals equities. Mm-hmm. That's down from a 4-decade mean of 2%. So if the allocation merely reverted to mean, you would have a 4-fold increase in demand. Mm-hmm. I have no idea what a 20% market share, which would be a 40-fold increase in the allocation, would do. I don't think it will occur, to be honest with you. I don't think a 20% allocation, given what I see to be the certainty, the inevitability of a decline in US dollar purchasing power, combined with artificially low interest rates. I don't think in that circumstance that a 20% allocation is out of line. Think about the arithmetic of the competing instrument, which is certainly the US 10-year Treasury. If inflation continues at its current pace, and by the way, inflation should not be measured by the CPI. If inflation maintains its current pace, which I think is closer to 8%, and the interest on the US 10-year Treasury stays at 4.5%, what that means is that gold's competing instrument, the US 10-year Treasury, guarantees that you will lose the delta between inflation and the interest it pays, which is to say 3.5% a year for 10 years. In other words, in the US 10-year Treasury, you're guaranteed by the US government that you will lose between 35 and 40% of your purchasing power over 10 years. That's pretty constructive for gold. So that 20% number is a very interesting number. I don't think it has a hope in hell of occurring, but I wouldn't necessarily discourage it, particularly given what I consider to be the certainty of challenges around the US dollar maintaining its absolute purchasing power over the next 10 years, which I consider the probability of to be nil.
Is that something you would do, Rick? Would you allocate 20% of your portfolio into gold?
If you look at my own portfolio now, first of all, somebody who looked at my portfolio would say I'd be a moron to own physical gold. Because as an example, I'm the largest shareholder of Sprott, a brand name for gold. Mm-hmm. My allocation to gold and gold equities is higher than 20%, but that's partially because of my economic prejudice and partially because I've spent 50 years coming to understand the gold bull market. For me, it's at once an investment, a speculation, and a vocation. I do all those things.
For investors who continue to undervalue gold's long-term potential, Rick Rule's message here serves as a warning. He points out that the percentage of U.S. portfolios allocated to precious metals is a startlingly low 0.5%. Even a simple return to normal levels could quadruple demand for gold and silver, as that number was previously closer to 2%. Furthermore, the demand that would emerge from large institutions or major investors ever shifting toward a 20% allocation, as some Wall Street analysts have indicated, would be enormous and far greater than what the current supply could meet. Rick makes it clear that this is about math and reality, not just conjecture. While U.S. bonds, which were formerly thought to be safe, now guarantee a loss when adjusted for actual inflation, inflation is weakening the dollar's purchasing power. According to him, this makes gold a sensible and logical substitute that can withstand the upcoming 10 years of economic downturn in addition to serving as a hedge. Gold is one of the only methods to preserve wealth in that environment, he argues. And the U.S. government is essentially telling investors that if they retain treasuries, they would lose almost 35 to 40% of their purchasing value over a 10-year period. Additionally, Rick provides an intimate look into his own approach. Due in part to his 50 years of research into these markets and his in-depth knowledge of their cycles, his exposure to gold and precious metals is far above 20%. For him, gold is a way of life, not just an investment. However, he warns regular investors against imitating his high allocation. Rather, he urges people to think strategically, comprehend the role that gold plays in a portfolio, and acknowledge that we live in a time when conventional safe investments like bonds might not be as protective as they once were. If you enjoyed this video, don't forget to hit the like button, subscribe to our channel, and turn on notifications so you're always up to date. Thanks for watching.